Well, welcome everyone to today's webinar. I'm Mike Berger with LBM Journal, and I want to welcome you to this webinar that's entitled, Why Should I Get a Detailed Business Valuation? Now, the dealers we talk to across the country are often aware of the M&A activity in the industry, as well as the reported earnings multiples that independent dealers have sold for over the past few years. Now, this leads them to ask why they need to pay for an in-depth valuation if they can just multiply their earnings by the earnings of multiple reporteds in the press. Now, in this webinar, Stratus Wealth Advisors owner Sam Brownell will discuss this important question in detail by providing examples from their work with LBM dealers across the country of how a detailed business valuation can help prepare a business for a successful ownership transition by asking tough questions, determining strategies to maximize business value, and forming the foundation of a solid succession plan. They want their dealer clients to view a detailed valuation as an investment in the sustainability and growth of their company that recognizes the history of the business and how that connects to the return on investment future generations will realize through better understanding how to create and maximize business value. Now, a couple of details as always before we get started. All of the attendees are muted, so you can hear us, but we can't hear you. So if you're having any technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work as quickly as possible to address those problems. Now, if you have questions for Sam, click the Q&A button at the bottom of the screen and type in your question there, and then he'll address as many of those as we can at the end of the presentation. And lastly, we expect the webinar to be finished in about 35 to 40 minutes or so. We are recording it, and we'll send a link to the recording to everyone who registered. Plus, we'll post the recording on lbmjournal.com. So having said all that, let's get started with the webinar. Sam, great to have you here today.
Yeah, thanks, Mike, and thanks for everybody for tuning in and registering, and I hope everybody had a good holiday weekend.
Yeah, you as well. So go ahead and kick this off for us.
Perfect. So again, thank you to everybody for coming today, and it's a topic that we often get asked as we're starting to engage with a client is, well, I've got an idea, a dealer across town or somebody I read about in the newspaper sold for 5 times or 4.5 times, and so that's great, and it's good to see what other folks are selling for. But as anybody who's been involved in this industry knows, every business is different, every area is slightly different, every product mix that a different dealer carries is different, and so getting into those details become really important. And evaluation does more than just produce a number. It should provide you with the ability to defend what your valuation is. So you don't just have to say, yeah, I've got a number here, but why and how? Those are questions that get asked a lot depending on who the audience is for the valuation. And we'll get into all of this as we go through the slideshow today. But I also think it's important to know that it's about the thinking and the thinking within the organization, because any evaluator worth their salt is going to come in and look at this like a potential buyer would do. And that's going to provide you with the opportunity to be able to think a little bit more strategically about how you're structuring a business, what type of product mix do you have, what are your margins, how do we maintain or grow those? So questions that are strategic and operationally related get into a business valuation, because the business is going to be worth what any buyer can get going forward. It's great that you've done as well as you have, but we want to know what we can do from this point forward. How do I make money with the tools that you have in place? And that's going to drive a lot of what somebody is willing to pay for the business and what the business is ultimately worth, and more important, how to make it worth more and more marketable. So just a quick background here on us. We're Stratus Wealth Advisors. We do a lot of work in the LEM industry across the country, independent dealers all over the country. We provide valuation services for all different types of purposes, and we'll jump into some of those purposes later. We'll maximize value. We talk about how do we do that. And then succession planning. How do we get this business to transition? How do we do it smoothly? How do we make sure you get the most net out of this? How do you protect the net worth of your family? And then how do we make sure those assets grow so that you're able to provide not just for this generation, but for future generations? So, little cartoon here to get things started today. This is typical of people. Doesn't matter if they're in the LBM industry. We're always going to grab for those temporary short-term solutions. It's easier to think about. The reward might be a little bit sooner. Thinking strategically can be a little bit harder because it takes time to see if that strategy bears out. And so one of the areas that gets really hard, and as it says right here, it's a little bit hard to reach, is this idea of succession planning. We may even sit down with our leadership team. Some of us may have board of directors and think through strategically. What about these different markets? What about this different technology? And those can be great strategic conversations that can drive operational efficiency and profitability. And one of the ones that often gets left to the side is this idea of succession planning. You know, what's the business worth? How am I going to transition it? Because it's hard. It's kind of amorphous. It's hard to really pin down what you should do first, who you should talk to. And I think importantly among that as well is it feels like a lot of work that you don't have time for. And we totally get that. And so because this is something that you're typically only going to do once, and most business owners are only going to transition a business once, it's important that we get this thing right. And it's important that we set it up and see this as an investment, right? If I'm going to put a certain amount of money into my succession plan, let's say, you know, hey, I'm going to spend X dollars to do this succession planning work. Well, if my business can be worth 4 or 5 times X down the line, then that's an investment. That's a good thing, right? This isn't just a cost center. And we want people to start thinking through that, especially when you start doing strategic planning. Is yes, there is some upfront cost to it, but it's a little bit different than your general operational cost of doing business. And so thinking of it and finding the right strategic partner to be able to see and realize that return on investment, that's really what we're going for when we go through this process. So here are the discussion questions we're going to go through today. We're going to talk about, are all valuations created equally? How do you determine what type of valuation you need? What are the benefits of a detailed business valuation? And then what steps should I take right now? Right? We always feel like it's good to have some implementation in there, as opposed to this is great information, but now what do I do with it? So start off with a little parable here, and it's a statistics parable, and statisticians are not very funny, but this one plays into that idea of taking a multiple that you read or a range of multiples. And it's the idea that if you're looking at something on average, right? Oh, on average, you know, lumber dealers get somewhere between 4.5 and 5.5 times earnings on a multiple. Well, it's the same as the 2 guys that came to a river and it said, river crossing, average river depth 4 feet deep. Well, they get into the river a couple feet and it's up to their ankles. Keep going a little further, it's not much deeper than their ankles. Keep going, maybe it gets up to their knees. And then all of a sudden the bottom drops down to 30 or 40 feet and the current's going really fast and they get swept away. And so the idea is that it's very difficult to look at an average and apply that to any individual case. And so the idea here is that averages without context are not really reliable. And just because we see something quoted or we see an average range, and you know, folks in our position are happy to quote ranges, oh, you know, from this to this. But the reality is that we've seen people's business transfer from everything from net book value, right? That's just assets minus liabilities, all the way up to 8, 10 or more times earnings. And so that's a big range. And a lot of it will depend on your specific business. And so trying to use, you know, an average or an average range of what businesses are selling for can set you up for some disappointment really down the road, because it may be that your business is not in the same shape as somebody else's business that got this multiple. So what we want to do, especially with this valuation process, is try to correct that. So let's jump in. Are all valuations created equal? So questions to ask, and we'll provide these slides to LBM Journal so they can send them out after this webinar. But these are things to really think about when you come in. What is the purpose of the valuation? Right? Is this a valuation that we're doing for financial planning? Is this a valuation that we're doing to gift shares to a child? Is this a valuation that we're going to use to buy out another shareholder? Or is this a valuation that we're going to use as the basis for our negotiations with a third party? So the purpose here is really going to matter. And so you have to think through that. Who is the intended audience? Say that I am, we're working with a dealer. They have some kids who are interested in the business. And so we're going to start off and we're going to gift a minority share, maybe 10% to each kid. And so the current owners still maintain both the biggest ownership interest and the control of the company. They're still making the decisions, but they want their kids to start to understand what it's like to be the owner. So who is the audience? Well, the intended audience of this is the IRS. And that is an intended audience that we have to be very transparent, very upfront with, and make sure that we can defend the value of this business. And so we need to know who the audience is. If, on the other hand, that audience is a private equity firm or something like that, you're using an M&A advisor to go through that process. Well, again, we have a different audience. This is going to be for negotiation purposes. And so we're going to need to come up with some really good reasons why we have this specific product mix. What happened in these years? How did you deal with price volatility? And so again, the valuation is going to need to answer slightly different questions. And again, as you go down the list, type of value, and we'll get into this in more detail later. Is it equity value? That's what as the owner, I'm going to walk away with. Or is it enterprise value? That's what a third party would pay for the operating assets of my business. What due diligence has been performed? Right? Is this something where somebody has come in and actually dove into the business and the books like they were a buyer of the company or not? Okay, that's really important. How well does the analyst understand the industry? And every industry is different. And somebody might be really, really good in one industry, maybe let's say construction or HVAC, but have they spent any time in the LBM industry? Again, does the analyst understand your industry? And do they, again, produce more than a number? And I think that becomes really important as an owner who wants to walk away from spending money on something and feel like they have gotten a return on their investment. If all I'm getting is a number, well, that number doesn't tell me a whole lot. That doesn't tell me where I'm strong. It doesn't tell me what are the areas for improvement. It doesn't help me think, okay, what do I need to put in place? What are the processes that might need to change? Okay, so these become really, really important questions. And this gets back to that flaw of average, that idea of comparable data. What is truly comparable? And there are lots of databases out there. You can go in and pay for this data and see what different companies are transacting at. But the thing is that each one of these companies is different. As those questions say at the bottom, what were the margins considered? What was the product mix? What was the entity structure? Right? If you're an LLC, you're going to be taxed different as a C corporation. So somebody thought through that. And so making sure that if we are using comparable data, it is truly comparable to our company becomes really, really important. And again, this gets back to one of those ideas about the flaws of averages. What are you getting out of the data? And how does that actually help you drive your goals, your business, your family net worth, all of these things? Really important stuff to think about. So let's jump into this idea of type of valuation that I need. So we strongly encourage anybody who's doing anything that is strategic in nature, be it a valuation or succession plan for your business, be it a personal financial plan, estate plan for your family, start with your goals. Outline your goals. It's much easier to build a plan if you know what your goals are. Otherwise, you and whoever your advisors you're using are just you're stabbing in the dark, right? It's the classic monkeys throwing darts at a board. So establish things like timeline. How long do I want to be working on this? How long do I want to be in the business? Is there a predetermined value I have in my head? Lots of times folks will come in and say, I would like to get $8 million for the business. Okay. Well, one of the questions a good detailed valuation can answer is your business worth that much? And if not, what do we have to do to make it closer to that value in your head? Because anchoring can be a very difficult psychological barrier to get around. If somebody is anchored on their business being worth a certain amount, or I have to be worth at least as much as my buddy across the state, those can be very difficult to get around unless we're going to be willing to dive into the details and be open and honest. Is there an ideal buyer? Have you thought this through? Do you have somebody internally, or would you like to do it internally? We have clients who will say to us, we really want the name to stay around. We really want XYZ Lumber to continue to be XYZ Lumber. We don't want it to become part of some large roll-up. We want it to be able to operate the way it has, to be able to provide employment for the community, to be able to give back to the community the way it has for the last 60 or 70 years. So think through that. How do you fit in post-close? Right? And do you want to sell all the business, or are you going to sell a partial stake of the business? Or are you going to step down over time? All of these things become important discussions, which then get back into the idea of this valuation. Is it the whole business? Is it part of the business? Are you gifting the business? Or are you trying to sell it for fair market value? So we asked this question a little bit earlier, but this is the type of value. And we're not going to spend a ton of time here, but if folks have questions, feel free to type them in. But equity value. Equity value is what we as owners of a business walk away with, right? If I buy shares of a publicly traded company, I'm owning equity in that company. If I sell those shares, that's the equity value, right? In your business, this is the value to the owner. And it includes non-operating assets, but not debt, right? So equity value is going to be net debt, right? Because of the fact that as an equity stake, you go lower in the chain of what gets paid back than the debt holders. And therefore, you have to subtract debt out. Now, enterprise value, and this is where you will see a lot of these multiples. And again, this is why it's really important to know where the numbers are coming from, because enterprise value, which is where you'll typically see these 4.5, 5.5 times EBITDA, right? Earnings before interest, taxes, depreciation, and amortization numbers. That's what a third party would pay for the operating assets of your business. If I'm going to buy Mike's lumberyard and I'm already a dealer, I don't want to take on any of his liabilities. I've got my own liabilities. And I just want to buy the operating assets of his business. So I'm going to pay enterprise value for that. All right. And the relationship between the two is equity value equals enterprise value minus debt plus cash. It sounds funny, but cash is actually what is considered a non-operating asset, because if you're running your business with the cash in the bank, as opposed to the receivables you're collecting, the inventory you're turning over, then your business is probably not going to be in business very long, right? So cash is what is considered a non-operating asset. It stays with the owner as part of their value. So types of engagements, and we'll definitely jump in and do some future webinars that are a little bit more specific to each one of these. But if we're starting off a succession planning engagement, we might do an initial conclusion of value. Right? That's going to tell you where the business sits. That's going to help with things like estate planning. Right? The last webinar we did talked about at the end of 2025, depending on what happens in the upcoming election, the current estate tax exemption may get cut in half. And so that could have a large impact on protecting and preserving the net worth of your family. So knowing what the business is worth is a great baseline to helping do things like, maybe we do gift some stuff to kids. Maybe we use something like what's considered or called a spousal lifetime access trust. Moving value outside of your estate to help avoid estate taxes, to help protect that family net worth. This is where you need a detailed business valuation. Just multiplying your earnings by an average number is not going to hold water. Buy-sell shareholder agreement, right? These are, hopefully, if you have multiple owners in the business, you have a buy-sell or shareholder agreement that will discuss how do we get out of this if something happens: death, disability, divorce, personal bankruptcy, retirement. termination, various trigger events that will cause a buyout. Because the last thing we want is a divorced spouse owning part of a business. And nothing worse than when you have a disgruntled spouse who is able to vote or at least gum up the works enough that every single big strategic decision requires somehow going around them, right? You don't have the time to think about that stuff. But again, these are the types of valuations that could easily be challenged by the other side. So you need some detail. You need to be able to defend your conclusion of value. Same thing with a state gift or grant. This is all IRS. I remember earlier we talked about who is the audience. The audience really matters. And so when it is potentially another negotiating partner, when it's the IRS, this is the time when it really, really makes a difference. That return on investment that we talk about is really, really important to you, because you don't want to go in there and have somebody all of a sudden pick apart, well, did you think about this? You didn't do this. Why didn't you do this? That leads to one of two things. Either you end up in tax court, or you get a letter from the IRS saying this should be worth a lot more, and you now owe estate tax, or you have a buyer who says, these people don't know what they're talking about. I'm either walking away or I'm going to offer a lowball price for this because I don't think these people really understand what they have. So again, a strategic investment in a valuation to get you as the owner thinking in a position where you can get a return on investment from your life's work. So great segue into benefits. Benefits of a detailed business valuation. Strategic goals. And this is one that I think all of us have heard many, many times, this whole idea of working on or working in the business. And it can be very difficult when you're running a business, day-to-day operations, fires to put out, all this stuff, to pull back and think about some of these longer-term strategic goals. But remember, a more profitable business typically is a more marketable business, which means it's a more valuable business. Somebody is willing to pay more money for that. And so what we need to do with this valuation to create that return on investment is to spark these conversations about ideal outcomes, right? What is the ideal outcome for the owner? How do we get there? Because at the end of the day, just like your job is to sell products and services and to be able to provide good feedback to customers, help them solve problems. It's the same thing with us. We're sitting here trying to help you solve a strategic problem, which is how do we take something that is inherently illiquid in a business and make sure that we can monetize it and do it in a way that is tax efficient and do it in a way that protects the interests of your family, protects the interests of the business, the employees, the customers, and your community. And so again, we're looking at how we can make this a return on investment for you as the business owner, right? As the client of ours. And at the end of the day, running a business that is more profitable, more efficient, makes it more marketable, helps to maximize value. That's a return on investment right there. Now, operational due diligence. Again, a good detailed valuation is going to be very similar to what a buyer would do when they come in. And believe me, if you want a buyer to be paying top dollar for your business, then you need somebody objective to come in and ask those hard questions before the buyer does. Remember, as a buyer, it doesn't matter who the buyer is, whether it's an internal buyer, whether it's an external buyer, that buyer wants to know, how do I make money with the tools that you have put in place? And your job is to tell them how to do that. And the more of these questions we answer in a detailed valuation, the more of these processes and procedures we put in place, the more we define roles and responsibilities, continuity plan, decision-making. This becomes a huge one in any type of transition. Who is making what decisions? Is that okay with everybody? What are the areas of expertise? Are we going to run into issues? And this happens regardless of transition. This could be an internal family type transition where you might have different family members who feel like somebody's stepping on somebody else's toes, or somebody hasn't been quite upfront or honest with them about something over the years. Could be external, right? Where you have a company coming in and they're thinking, geez, we don't really have chain of command here, we're going to have to invest some money, maybe in new hires, maybe to outline an organizational chart. But whatever that buyer is thinking to themselves, geez, I'm going to have to put money into this. If I have to hire a recruiter, I might have to pay, hire another GM. That's money they're not going to pay you. So you need to have the answers. How do you make money with the tools I have in place? You shouldn't have to do anything but come in here, use the good name, the good operations we have, and keep going. But again, you don't dive into this due diligence and have somebody objective do it before you get to that negotiation stage, you can end up leaving some money on the table. Right? And this just gets back to this idea we talked about earlier, right? Return on investment. And we've got to be looking at both the quantitative side, but honestly, it's the qualitative side that makes the big difference in these transitions and in these valuations. And even though it is subjective, doing a good due diligence and understanding the operations of the business, understanding the leadership of the business, this can definitely impact the multiple that somebody is willing to pay for your business. Because that qualitative ability, what are the operations? How well defined are they? Do we have an owner that is still doing all of the purchasing? Are they the ones who are the primary salesperson? They have all the good relationships. Now, this is transitioning somebody out of the working in part to the working on part. And chances are you have good staff, and this happens in a lot of cases. There's good staff that can take on a lot of your roles. It's just very difficult to give it up sometimes. And so sometimes we need to sit down and we need to talk about that chain of command and that decision making. Get everybody at the same table. We're not trying to make anybody feel like they're having to give anything up. We're creating a path forward. How do we create a path forward so that the business can present in the best possible way, the most valuable way? All right. And like anything, it's like going to the gym and getting an initial evaluation from a trainer. What are the strengths? What are the weaknesses? All right. How do we increase margins? How do we maintain margins, profitability? All right. What's our marketing presentation going to look like? And what's our listing presentation to use language from the real estate agents or from real estate agent, real estate industry? So it's a lot of stuff in there. And of course, we're happy to take questions. Happy to please reach out to us. We're happy to have a chat with anybody. But steps you should take right now. This is the ABCs from our perspective. Appraise the business, build a succession plan, calculate your net worth. These three areas will really help you feel a little bit more secure and a little bit less panicked about what do I do? Because it's a big step. You've inherited the business, let's say, or you bought the business, you started the business. Either way, it's your baby, right? It's another one of your kids, and you want to make sure it's well taken care of. Best thing you can do is start off detailed valuation. What is that business worth? What do I need out of it? And where do I go from here? All right, that detail is going to matter. That's going to provide that return on investment. It's going to allow you to negotiate confidently. So we're here to help. We do this all the time. We work with folks all around the country, dealers who do all kinds of different stuff. Some have hardware, some don't. Some do a lot of value add products, some are more commodity. But thinking through where you are right now, where you want to go, really helps, because typically people only do this once, and we want to make sure that it's done right. So again, we'll provide these slides. Feel free to book an appointment with us. We've got the complimentary 30-minute consultations. Happy to do it. We've got some resources on the website, and we'll be at the LBM Strategies Conference next month in Southern California, and sitting down at a roundtable there, as well as available just for scheduled meetings or one-off conversations. Happy to be used as a resource, and we know that this is difficult stuff, and you want to do the best for all the different stakeholders, and we're here to help. So with that, Mike, we'll turn it over for any questions.
Sam, thank you so much for all of that information. Folks, this is a great opportunity to pick Sam's brain and type in any questions you may have for him on this, and we'll do our best to get answers for you.
Yeah, absolutely. And don't be afraid if, this stuff can be a little difficult to talk about. You may not want to ask something because it's confidential, or you don't want to put somebody on the spot. But feel free, right on the screen, you've got my number here, email address. Either one is also a great way to get in touch with us.
And as Sam said, he is going to be at the LBM Strategies Conference. So it's also a great opportunity if you're going to attend, and I hope you are, to pick his brain there as well. We're lucky to have him on the roundtable there.
Yeah, absolutely. No, thank you. Thank you, Mike. And thanks again to everybody. And I hope everybody had a good 3-day weekend. We're kind of headed into the big meat of the second part of the year here at the beginning of September. So we know you all are busy and you got lots of things to think about. And my 2 cents here would be, remember that doing this right is a process, and it takes 2 to 3 years, at least 3 to 5 years is better. So the sooner you can start thinking like a business owner that is ultimately going to transition your business, the better it will be for your business, for yourself, for your family, and it will require a little bit less from the planning process at the end to try to get everything into place to make sure the transition is smooth.
Well, Sam, again, thank you so much. Thanks to all of our participants today. And we'll send you the link to this recording, and you'll be able to get copies of all these slides. And we'll also have a link on our website at lbmjournal.com.
Perfect. Yep. Thanks, Mike. Thanks, everybody.
Thank you.
Appreciate it.
Everyone, take care.
All right.